Yeah, Michael, what do you think the pace of those rate cuts are likely to look like? We talk so much about when the Fed is going to start cutting, but I think what matters more here to the street, and I know you've written about this, is more so the pace of that and what that more realistically or accurately could look like.
Right. Very, very quickly here, it's going to shift to pace and endpoint for the market. I think at least initially, the view will be it's a quarterly cut cycle. So a gradual cut, it's a normalizing policy rate following inflation down. Inflation's decelerating gradually, so cuts are likely to be gradual. But obviously, the further you look out, I mean, we can write down these kind of stylized baseline forecasts that assume a lot of things work out well, and I still think that's right. The economy just, though, it rarely evolves in kind of these straight line, smooth fashion. So the further you get out into 2025 and you're past the election and we know kind of what policies we're getting, maybe the view's different. But I think initially, as we look into the rest of this year and perhaps the early part of next year, I think cutting quarterly makes the most sense from the Fed.
We've been talking about inflation, the labor market. Anything else on your radar in terms of data that we haven't really touched on that you think is important to the calculus at the Fed?
Well, I think that part of the calculus in markets and at the Fed is, as you have identified, what is the real risk of a sharper slowdown? Is a normalizing economy following a pandemic the same as a weak economy? And I think the GDP numbers yesterday should assuage some of those concerns that we're in the midst of a more rapid slowdown. I still think the economy is healthy, and I still think a normalizing labor market isn't a weak one. So the key here for me is to say employment growth should be slowing, but that's not because we have overhired and firms are ready to pare back. Employment growth should be slowing because we've caught up to where we want to be. That's a very different dynamic. So I do think that, at least in a risk dynamic story, the GDP data should give the Fed less concern about a sharp slowdown in the economy.
Resilience is the key here. Thank you, as always, Michael Gapen, BofA Securities Head of U.S. Economics.